I've made countless videos on my day trading strategy, and right now, right here, today, I'm gonna break down my strategy for you so you can take it and turn it into gold for yourself and utilize it and make money in these markets today. So let's get straight into it. Welcome back to the channel, and if you are new here, my name is Divine. My job is to help you develop as a trader, go from a beginner to a professional trader, and most importantly, make trading as simple as possible for you. So today, it will be a long one, so get your pens and notebooks, but make sure you stay later on in the video because we will be breaking down the number one thing, the most important thing with this strategy that you need to know to succeed with the strategy. And no, I never BS y'all. This is not a get rich quick thing. This is something that you need to collect data, put lots of effort into, stay disciplined, stick to your plan, and you will succeed. So make sure you stay to the end of the video, hit the subscribe button, and let's get straight into the video. Okay, as you all know, we always start with very, very simple breakdowns because I need you guys to be able to see this as clear as possible. You need to know the textbook version versus what the chart show because it is not always as textbook as it looks on the chart, as you can see here, but it does allow you to get the overall agenda, the overall concept of what we are trying to break down here. And this is four things that plan out my strategy. One of them is time, and we'll go over time, but the four main characteristics of my strategy. So let's get straight into it. We're going to go over the very simple version, and then we will get into the candlesticks. Like I said, the number one thing we will talk about, it will be a little bit later because it'll all blend together. So let's get straight into it. As we can see here, we talked about liquidity sweeps, and people get liquidity sweeps. It's very confusing, but it's very simple for me. As you can see our action here, liquidity sweeps is number one and displacement is number two, but they factor in and help each other and they show us intention. Why does this help us? Because it shows strength in the market. So when we have the price actually moving sideways or sometimes just pivoting in the market, creating higher highs, higher lows, we want to see price show some intention to take out old orders, old levels. As you can see here, if you watch my liquidity video, check that out because it's very important. In these areas, equal tops, double bottoms, triple tops, these are important levels of liquidity and price loves to go tag those levels. In this case, we take out these equal lows down here, relatively equal lows. And as soon as we take out that level, we take out a high, right? This high here, which created this low. The importance of understanding what a liquidity sweep is. Liquidity, just because you see price go low than high doesn't always mean it is a liquidity sweep. We want to see a sweep of some important levels, and then we want to break the level that created the low. And we also want to see a level of displacement. And what displacement will look like is a large candlestick. It will have imbalance, right? It will have a area where the wicks do not align. If you don't know too much about imbalance, I could go a little bit into it in this video, so stay later when I'm breaking down displacement. But when you get that liquidity sweep, the most important thing is you don't know when price takes the low that it's a liquidity sweep. But once it takes the high and it takes it with intention and strength, showing displacement that one side is in control, that's when we know, hey, that might have been a level that swept liquidity. For example, here, that's the buying side. Here's another example where we make a low and then we make another high, and then we take a low. And people might say, hey, it's a change of character, or it's something that it's a market shift. Well, understand that we may just be coming back to this level of demand, the 50% level here, respecting that, testing it out, and then we take out again. So what do? We take out an important low that made a high, we take out the low, and then we immediately, with that displacement, move to the upside, take out the high. And that displacement shows the strength in the ability of the market, the intention behind the market. We want to see those levels of displacement because it shows us that buyers are in control, or on the other side, as you can see here, we take the highs and then we show that big move to the downside. Sellers are in control. Now you may see something where you get a move down here and you don't actually take out those levels, but you get a move to the upside and you want to buy from there. We want to buy from levels that show the strength of this displacement, like so, these big moves, and we want to sell from those areas as well, like these ones where we show these exact same thing on the opposite side where we get these large levels of displacement in the market. No choppiness, no choppiness. Just sweep the highs, take the lows immediately. We play around, take highs again, and then we follow the move to the downside. And that's what we want to see as far as our liquidity sweeps and displacement. The very most important thing you need to understand when dealing with liquidity sweeps is the fact that you don't know it's a liquidity sweep when it takes the high, but once It's the move after that determines it, right? If you get a level that just takes a high and then it comes back and it just respects that level, then plays around and then it moves down, that's not necessarily a liquidity sweep. But that level that actually just takes that high and then just moves, that's what we want to deal with. That's what we want to see. That's the levels we want to look for, those footprints and trade from in the market in order for us to catch those large moves. So that is the number one and most important thing of our strategy. Write it down right now. Put it in the comment section if you have to. Right now, liquidity sweeps and displacement. And also write down that it is the most important. And also write down that after the move up or down is what's most important. That's what allows us to know that displacement allows us to know if it's a liquidity sweep or just another move in the market. Now, the next thing that's very important is the break of supply or demand. Some people call it a break of structure, either or. For me, it's breaks of supply and demand and dependent on where we are in the market. As you can see, we have moves up, higher high, higher low, higher high. And then a lot of people start to see this action. In reality, we are between this low and this high. All this action in between is considered liquidity because this high could not do what? It could not make a low, and this low right here could not make a new high. So we wait patiently for price to tap into something important, and then it makes that new high. Once it makes that new high, if that level is broken like so, and that level is broken, well, then you have a break of supply or demand or a break of structure in a sense. This is considered a break of demand in this case, and this is a second level of break of demand, which shows intention, which shows strength in the market. Why? Because this low's job was to make a new high, which makes it a strong low. Like this one over here, where we have a low that swept liquidity and made a new high. This is now a nice low to trade from if we were to come back to that level to create another high. In this case, price did that, swept this low, made a new high, but then it got disrespected, which shows sellers are a lot stronger in these moments. And this is no longer, demand is no longer on the protected side. If you ever look at lower low, lower high, lower low, lower high, one thing is happening. Another, and we know exactly what that is demand levels are being disrespected. Supply levels are being respected, right? So we understand that if these levels are breaking these lows, then we understand one side is being respected now. Now, does that mean we're full blown bearish once we see this break or full blown bullish once we see this break? No. What happens after is important because we can go back and reject and respect it, or we can completely reverse. And then we'll say, hey, this might have been a sweep of liquidity. So, the most important thing with these breaks of supply and demand is to understand what happens after price does these things. We break this low. Does price come back up slowly, plays around, struggles to get back up, maybe even make a new low or some sort, and then come back up and we create a low? Or does price immediately break that level and then take the high? Right? We want to be able to pay attention to that. And then the most important thing, in my opinion, because it is very, very beneficial to catching the big moves, is the premium and discount. Premium and discount, simple as like I said, you buy a car at a discount and you want to sell that car at a premium. You want to buy a shirt at a discount and you want to sell it at a premium to make a profit. Very simple. If you bought a shirt at $5, you don't want to sell it at $3 because you'll be selling it in the discount. If you buy that shirt at $5, you want to be able to sell it at $20 so you can make $15 profit. So on our charts here, when we are selling the market, as you can see here, we anything above the 50% we can sell, right? Anything above the 50% we can sell. At the 50%, that is our equilibrium point. That is the point where buyers and sellers are pretty happy with each other. Nobody's trying to take full control. Everybody's pretty much solid. No true control in the market. Price likes to play around these levels like this, do all the bouncing off of it, and eventually one side gets taken or what. And then in that discount, anything below that 50%, we are able to buy. So for example, if price came up here and we were in the premium, well, we would look to sell from that level. And if price was down here, playing around in the discount, we will be looking to buy the market. Even if we seen price make this market shift, we are still in our discount and we want to be able to buy from there. And once we see some type of move to the upside, and then we take out the first low, the second lows, we won't sit there and look to buy anymore because we were bullish. We will say, hey, we're in a premium. We will look to sell. So you want to have liquidity sweeps, displacement. You want to have a break of supply and demand. You want to see that, and then you want to make sure you are in the premium or discount, depending on if you want to buy it or sell. Never diddle in the middle. meaning at the 50%, stay away. I don't care how beautiful it looks, how nice the setup is. Stay out the middle because the middle is where liquidity is operated and manufactured and fabricated. And if you play around in the middle, you will get snatched, swept, and taken out. And they will take your money without thinking twice. So stay out of the middle, never diddle in the middle. So with that being said, we are going to go look for examples of each of these, and then later in the video, we'll go over that number one thing that you need and also break down some live examples that I took and that you guys just collecting data for you guys. So let's get straight into it. All right, guys. So when we look at this, when we talk about liquidity sweeps, as I mentioned, we want to understand that yes, we want price to disrespect lows and old highs, but we also want to see what happens after the fact. The aftermath is what actually tells us the story and shows us what direction or where the market is intending to go on most of the time. So when we look at a low like this, right? This is quote unquote a liquidity sweep, but it's not one that I would like because of a few reasons. Well, yes, we take these lows, right? Beautifully. We knock those lows out, tap into something here, but look at the movement afterwards. Had a nice wick, which shows a rejection, but then we get this, we get a break, then we come back here, we pause a little bit, then we take a high, and we actually don't even take out this action here to the left, which was what caused that move to the downside. So we will want to see something like this in order for us to trade off of it, right? Well, if we look that you can trade, as you can see, it was respected, but even tapping into those orders to the left with this wick, we just consolidated. So the level that we want to look at where this is very, very valid is something like so, where we have a push to the downside. We took all these internal levels here. We sweep those lows, and immediately after we sweep those lows, we do what? We create a displacement to the upside. If you look inside here, this candle has nothing but imbalance within it. And we don't only sweep, we take out these highs to the left over here, which shows one, we got a sweep of liquidity because this candle at one point was very strong. It looked something like this candle over here, very strong, right? So we could assume that we were going to go bearish, but we didn't. We actually rejected within that 1 hour candle. And then right after that candle closed, the next candle abruptly moved to the upside with strength. And then all we do is map out that level and we look to take an entry potentially with other confluences that we're going to talk about later to catch the move to the upside like this, where we might enter somewhere around here, maybe put a stop here, give ourselves a 50 or 70, 80. I don't know what your plan maps out to be, but give yourself a 100-point stop. I don't care. And then you target whatever you target, right? Let's look for another example. So another example of a liquidity sweep where we have price consolidating, right? And we actually had a level try to do it where we took a low, but what couldn't we do? We couldn't take these highs up here. It wasn't possible. It wasn't strong enough. It was not enough intention behind the market. So I cannot rightly so deem that as a sweep. But here, 2 a.m., right, which is London, or 3 a.m. Eastern Standard Time, that is London session open. We like to see a lot of manipulation and then move to the upside. Well, we get these lows here of consolidation. We sweep those lows, we actually respect this wick here, which tagged into something to the left. And then immediately after that happens, price makes what? A new leg to the upside. And within that leg, we leave a sort of imbalance here, displacement in the market. And later on in New York session, we create even more displacement in the market from that one liquidity sweep. So though you couldn't probably get in because price didn't return, one thing you can do is as you make that displacement and then start to see the bullishness, you can go in on the lower time frame along with some other confluences, and you can actually join the ride as far as getting in on the 5 minute, the 1 minute, maybe the 15 minute, and understanding that you had that liquidity sweep. And the importance of that liquidity sweep with displacement is the fact that this low is now a respected low. So we can actually start to move up and expect that process of higher highs, higher lows to stay intact until we start to move back to the opposite side. So let's look at one more example of a liquidity sweep really quick. So our last example is this one where actually I took a trade here from this level. And the beauty of it was, again, we have a supply that enters the market right here. We make a high and we take out this rough, minor low, right? So you can say, hey, like some bearishness happened here. That sort of shift happened in the market. But immediately once we take that low, New York open, I actually took this trade here, but we take that low and then we immediately take out a high, right? Remember what I said, what happens after is very important. Now, What happened after this was we did have sort of displacement, but the market came right back into that and played around at these levels. Me coming the next morning, I seen that level. Now this is a key level because we swept liquidity. We tapped into the 4 hour demand range here, as you can see. We made a new high in the market and we had some displacement, which allowed us to show intention, showed us who was in control on which side of the market. All we want to do is join a ride. I drag over my supply and demand zone, which we'll talk about, or you, as you know, in my other videos, I always talk about breaking down, and then you can take an entry here, like I did. Very, very simple. Nice, tight stop. I actually even got in a little bit more down here because price started pushing strongly to the downside. Understanding that this is a protected low, I just simply turned off my screen, didn't worry about it, targeted these highs. It was a Friday, so these equal highs here, and then got out of the market very, very beautifully. And that's how you can utilize liquidity sweeps. So now we are going to talk more about our break of supply and demand and the importance of that in different ways, on understanding how it can actually shift the entire trend, and then also understanding how an example like so, where we could continuate and get in a continuous trade. The importance of having a supply or demand break before you actually enter after the sweep of liquidity and displacement is because you do not want to become the liquidity. So even though price already swept liquidity, made an abrupt move to the upper downside, you still want to make sure that we break those levels to the left or to the right or whatever it is before we actually get into a trade. So for example, as we see here, we have a trending pretty bullish market. From this level, we make a high. And as you can see, we take out a high right here very nicely. And then we take out another high and we come down to this extreme. So something like this, even though for me, it didn't really truly sweep liquidity, this is if somebody who just trade pure supply and demand could take this trade, put a stop down there, and then they could target the highs, right? Very simple. But if we look, continue to onto that move, well, price didn't actually in this action over here, price didn't actually create a high in this move here. So we have a low, we created this high, we come down, we create another high. Well, this is our extreme low. Then we have price here where price actually started showing some type of action of demand, and people might say, hey, I want to enter off this because what did it do? It swept a low and then it showed some type of movement to the upside, took out this high, but this is not the high. This is not the true high. This is. So unless this level swept this low and then took out this high, then we can enter here. But in that case that it didn't and it was too weak, as you can see, it becomes liquidity. Both of these lows becomes inducement. And if you want to hear and understand more about inducement, comment down in the video because I did say it in my last video. Only one person said it. I need at least 5 to 10 people to say inducement in the comments. Write that down, and I'll make a video beautifully on it because it is heavily a part of my strategy. But these are the four main components. And if you utilize inducement and liquidity cycle a lot more, which is a video I already made, you all set. But in reality, when we get this level that can't make a high, we come down, utilize it as liquidity. If we draw out our supply and demand zone, we have a nice level here, and then we take our entry because this is the level that actually what? Took down lows to the left and then made a high, took out these levels. It is important in a beautiful level. Let's go look at another example. We have a level here that took remember, we tagged this level and then we took our highs, right? And then we come here and we get a sort of bullish action that come into the market. Well, you don't know that this happened. So when you look at this, you might say, oh, maybe we're tapping into this demand level here, and maybe we could get an entry from here, and then you actually get taken out quickly. There's a couple reasons why you will get taken out, but the most important reason that we're talking about now is because this level came to there and then you didn't wait for it to make a new high. But you do know the level that did make a true high, and it was this level down here. And this level here has some sort of supply demand range right here. We drag that over, price comes into it, and then as you can see, we do end up making a beautiful new high right here, ever so slightly, because maybe sellers are stepping in the market. Again, here, this is our low, this is our high. Well, we know we are bullish, but in the fact that people might be trying to enter here, don't become the liquidity. Wait for that level to sweep displacement, then take out the high or take out the low. In this case, we have a high and a low or a low and a high. We get this level, right? That comes back. Makes a run at the high, we can't take it out. Comes back, makes another run at this high, can't take it out. And eventually we take out a low, we come back and then we take out even more lows, and then we take out the main low, which shows bearishness. So in this case, I now know that this bearish range that we have here is now or this bullish range that we had here is now manipulated. All the orders were in. Sellers took control. Now I'm looking for sells. And again, if we were to look for sells from a place like this, I want to let demand come in and I want to see demand get broken. As you can see, we have this level here of demand. It's like as you can see, we have this range of demand here. We make what, a new high, and then what do? We take out this level. We come back to the level that took that level out with a nice order block here. And then we could potentially take a nice sell off the candles, put our stops here, and understand that we can do that because price has showed this card. It took a high and then it took some lows. It had a minor bit of displacement. I would love to see more, but it did its job at the end of the day by taking out that low. So you still know, even if you haven't seen the best displacement, you still know that that level, you may have swept that level out and then move to the downside, and you could potentially trade from that level and have a successful trade as far as following your plan. So let's get into the last example of premium and discount and the importance of premium and discount and how you can avoid losses. So when we talk about premium and discount, I'm going to make this very short and very simple because I always go over it, but it is very important. You want to buy low and you want to sell high. Every time you come to the market, remember we talked about what's the most important thing. You need to know who's in control. You need to have a trending market when you actually take this strategy and utilize it for yourself. Meaning, if price looks like this sideways, you cannot do anything because there's no true control here. We just have a lot of range action here. We don't know who's in control. But when we have price actually moving to the upside, and then we have some movement to the downside, we can clearly say, hey, I know and understand who's in control. Now, when we talk about the premium and discount, the most important thing for you to do is to figure out where your low and your high is, or your high and your low is if you are bearish, low and high if you are bullish. In this case, we are bullish, so my low is here, technically, and my high is up here. Now, everything in between is price action, and until a low is manipulated, then we may go into our liquidity cycle, which is something you can see on my channel on a video I made a couple videos ago. We have a move to the upside, and then we continue higher. Well, in this case, we make a high, and then we come back here, and then we make another high, we come back here, and then we make another high. And you may ask, what made us stop here? Well, here, we want to come back, or we have a low and we have a high, and we want to come back to buy. Well, we take our low, our fib to our high, and then we say, hey, where can I buy from? Anything around that 50%, deeper than that 50% is very, very nice. In this case, price came right back to the 50% and then made a new high. Same exact thing here. If we take our low to our high that we made in this market, you see price came to the deep, deep discount right here. If you don't have the settings for the fib, you need to set it up just set it up, double click it like so. And then you can set everything up like this, or you can just pause the video. We come back, and then what we actually do is we make a new high, and then we break that level. We enter our liquidity cycle, and now we actually go bearish. So from our low to our high, we know that we are now selling high once we get up here. So anything above this 50%, we can sell in. And as you can see, price comes up here and makes a new low. Now you might ask yourself, well, we're bullish. Why didn't price stop here and then make a new high? Well, that's because we are on a larger scale, on maybe our daily or our 4-hour high to low, we are above the 50%. We need to get deeper into this discount down here, gather enough orders for us to move to the upside. As you can see, price makes its way up. The moment we take this low, we are now shifting. We go to a bearish market, but that doesn't mean we're fully bearish. We're going to take out the lows. That just means that we may have to come back down to these deeper levels in this area, or these areas. As you can see, we come all the way down here, respect those levels, and then we can take our entry. And as you can see from that level, if we were to drag it all the way over, it is not a coincidence why price actually came to that level, respected it, and then made a beautiful new high. And again, we take out a low, we take out a high. It shows our sweep of liquidity, our displacement. We take our fib from low to high up here. As you can see, we come back into the discount, and then we enter there down here somewhere. You could get another re-entry if you would like. I wouldn't, because it didn't do what? It didn't take out the high. So that means potentially this could have came down here, swept these lows as well, and then made that new high. But I would love an entry like this where you have a nice stop loss and then you move to the upside and map everything out together, because what? You have your sweeps of lows. You come tap into a demand level. Of course, we like to see that. We take out this level abruptly with displacement. We come back to our discount level to buy because we want to buy in the discount, and then we make our move to the upside, and it is all beautiful. So the last thing I'm going to do, guys, is go over two examples in two different markets. One is going to be the crypto market, and one is going to be the Forex market, and show you how this works every single day, all the time. So as you can see here on Ethereum, we have a very clean setup. Remember the three things that we need. We need a sweep of liquidity with displacement. We also want to be in our discount if we are buying, or be in our premium if we are selling. And on top of that, we want to make sure we have a break of supply and demand to show that intention in the market and the trend, meaning the trend in market. Once we break that supply and demand, it shows the intention, it shows the strength, it shows the conviction behind the move, and we want to get in once price comes back to that level and join the run. So when we are looking at this again, our move came here. And validating why price did that, well, again, we have a level of consolidation. We make a move to the upside. Price comes back into that level, and it does respect this entire range here. But what it did was take out a ton of lows in order to make a move to the upside. In this case, we came all the way down to these levels and took out these lows with the slightness, right? Nice little sweep. Took out all this area here, took out any buyers and sellers in here that was stacked in, made them think we were going to go lower. And then immediately after that, within one candle, we take the lows, we break above these highs, we actually test that level again. And then as you can see, we get the true displacement to the upside. Now, we want to make sure we want to find our supply and demand levels. The easiest way to do that is take your fib to find out where your discount and premium is. Once this level made a high and then we took the low, we know that we are entering a liquidity cycle. Our discounted level would be something like this wick right here, technically, because this wick was the cause of the move that broke this level here, which is the second or the third most important thing in here, where we want to see that break of supply or demand like we got right there. And you see why price came back to this level, tested it out, made a new high, and then we take that level. We know that this level is lined up in our discount, and we also have more levels lined up in our discount. We have this level lined up in our discount, but as you can see, it did make a new high. So um you could try to buy off this level to make it even higher, but it is very risky because it is where, if we go back, it is right at the middle. Remember, never diddle in the middle. So this is a prime example of, hey, price did tag the discount. We come back to the level. You see how we play around at that 50% a ton, even over here. And then we eventually make the high, or we eventually go below it, or whatever it is. So you want to stay away from the 50%. So in this case, this would be the most ideal, maybe even drag it up to this black candle. And then we'll say, hey, now we got some nice, beautiful inducement. Remember what I said earlier in the video? If you want more information on inducement, because it is huge in my trading strategy, comment below inducement. I need 10 people to comment inducement, and we'll make a beautiful video on that deep depth, because it is very important to my trading plan and to my success. Coming back to this level, we know this is our discount. We took out supply, or a level of supply. We swept liquidity. We have everything we need. Price comes back to this level. All we're going to do is enter where we see fit. This is a little later in the day. Honestly, I'll probably enter as soon as we get to our area, and then I'll just put my stops there. And then I'll target this high. The reason I put my stops here is because this level should be non-protected. If you want to stretch it out a little bit more and bring your entry a little bit deeper to the 50%, you can do so. But me, I'll enter there and then protect my stops there. And again, simple 1 to 2.5, very calm trade, very smooth trade. And that is as simple as it gets in these markets. You just wait for it. It happens all the time. So let's go look at another example on GBP USD, or actually let's do GBP JPY. Here is a beautiful example on GBP JPY. It is not the cleanest, and that is purposefully done because every trade is not as textbook as it needs to be. But in this case, we get a beautiful consolidation. We already are very bearish. Beautiful consolidation, and price does what? It moves to the upside, taps into something to the left that was probably of some importance. If we drag that over here, we get a nice supply level here, which created some lows down here. Obviously, price wanted that, like that level. We got there consolidated, and then we get a huge level of displacement, and we create a low in the market around here. Now, we got a few things going on. We have our consolidation. We sweep the levels. We got our sweep, but we only know we got our sweep because we got the displacement and the break of these lows down here, which is our break of demand. In that case, we want to map out our premium and discount levels. And the reason we want to do that is because I don't see a clear level of supply here, but I do see a level like so where we have a supply range, high to low. And within that range, we have a lot of displacement and fair value that we can go to and trade off. So we have our high to our low here, as you can see. I'll drag that over so you know the low. You got our nice little thing in there. And we immediately come back up. As soon as we make that low, we come right back up to this level. And this is something I trade, and it's something that I just see a lot, and you can take it. But a lot of people don't understand. They might say, "Hey, man, this is a huge stop loss. This is, I don't know." Well, at the end of the day, you want to get in the market. You want to be able to get in the market and not sit there and have to worry about anything. This is a trending move. This is a clean move. This is something that you can get into and you can hold it and hold it and hold it depending on where we are on the daily range. So in this case, though price didn't come deep, deep discount like, I understand that we have a ton of imbalance here on the sell side. All price wanted to do was come back up here, come back to this point, give fair value to the sellers, let the sellers get in or buy or step in the market as well, give them the opportunity, and then you see the sellers took over, and that is a clean trade to the downside. And then we even have another trade where you sweep liquidity here, where we sweep liquidity here to the left. We move down without a true amount of displacement, but now that we are trending, we could trust in our process. We could drag out this level, say I like it because why this level is in the premium of that high and low, as you can see here, if I drag it over, that is a premium level where our levels are. We have a clean area where we can trade from. And then we also have some targets and we go here, put our stops up here, whatever. We can target these lows or just target what we see fit and we get a clean trade out of it. And again, we have some more inducement to validate our trade as well. So with that being said, matter of fact, I got a bonus for y'all. Let's go to Apple or something. So let's see if we can find this on Meta, Apple, or something. Actually, I think I found levels already. So let's go here to the sell side. So stocks, very ugly. I don't like it, but in the reality, it's the same exact stuff. Again, we get a level of consolidation here. We get this high here. We sweep the high. We tap into something to the left, which was probably from a supply chain. As you can see here, we have this here. And this is all in hindsight, of course, but this is how I would validate price if I was live in the market trying to figure out what was to come next. We sweep the levels. The reason I know it's a sweep is because what happens afterwards, we immediately take out these lows. So this is a clean level for me to come back to the next day or whenever to take a trade from. Again, our premium and discount, this is our high, this is our low down here. As you can see, that's our low. We come clean into that premium levels of supply. We can literally throw on an entry here if you want. I'm fine with that and hold it. Put our stops here, put our stops here, wherever you want. You got a $6 stop or whatever. And then as far as targets, you have a nice simple gap down here. I learned this in Forex. Right here, you see a misrepresentation of the market, and you could target right to those levels and allow price to get down there. And then on the buy side, I seen another example up here where, again, very simple. We get a nice sweep of some lows. We abruptly take out this level here with some displacement and some gaps showing that strength on the buy side. And then from there, we map out our demand zones. As you can see, we get the demand zones. We come back here. We understand that this is our discount from our low to our high. Price comes back into that discount. And then we could throw on the entry somewhere around here, depending on the time and everything like that. Whenever you trade, and you could hold this for a week or two if you wanted to let price go out and actually smack the trade. So this is how I trade my strategy. This is how I look at it. I will go on any market and I will back test and collect data on it because it happens everywhere, which allows me to build confidence behind my strategy and be able to trust it in the live markets. And this is what I want for you too. So make sure if you did find value, do me a favor, hit the subscribe button, hit the like button, throw a comment in there, and I'll see y'all later. Love y'all.